Over the last 2 decades, China has developed into an economic powerhouse. No other country in the world has seen the same level of growth as China. But what if I told you that China's entire growth was a bubble? Kathy Wood, CEO of ARK Invest, believes so, comparing China's growth to Japan's 30-year economic disaster in the early 1990s. Once again, Western experts predict a Chinese financial crash. One commentator claims that China is flailing, while another claims that a debt bomb is about to explode. China's demise will be driven by the bursting of the property bubble, excessive debt, and the grinding down of the economy as a result of the government's terrible zero-COVID policy, which keeps parts of the country under permanent lockdown. Then there are the growing restrictions on China's exports and investments abroad, imposed by the US and ostensibly supported by its Asian allies. How much truth is there in the most recent round of criticisms of China's economic progress? The real estate crisis has reached dangerous proportions. Evergrande, China's second-largest private property developer, was on the verge of bankruptcy last year. The Evergrande property model is essentially a Ponzi scheme in which the company collects cash from the pre-sale of an ever-increasing number of apartments, as well as hundreds of thousands of individual investors, and uses the cash to fund further sales by speeding up construction in progress and funding down payments. This, like any Ponzi scheme, works as long as it accelerates. However, as the market slows, those incoming cash flows begin to lag behind the expanding arc of cash demands. Evergrande now has approximately 800 unfinished projects and approximately 1.2 million people waiting to move in. The property crisis has now reached a point where millions of Chinese buyers have stopped making initial mortgage payments. The rapidly spreading boycott of mortgage payments by Chinese homebuyers has spread to at least 301 projects in about 91 cities, with a total value of mortgages that could be affected reaching an estimated 2 trillion yuan or $297 billion. Real estate accounts for roughly 70% of Chinese household wealth. Some Chinese banks have reacted by seizing buyer savings deposits, claiming that they're actually mortgage investment products. This has resulted in open protests outside some banks, prompting the government to surround the banks with tanks. At the same time, China's usually spectacular annual real GDP growth has been slowing, even before the COVID slump in 2020. While the recovery was strong in 2021, new outbreaks of COVID variants resulted in new lockdowns. The Chinese government has been enormously successful in its zero-COVID policy, keeping the death rate to insignificant levels when compared to the major capitalist economies. However, economic growth and employment have suffered as a result. The Chinese economy shrank by 2.6% quarter-on-quarter in the 3 months to June 2022, according to seasonally adjusted data. In May, the nationwide urban survey-based unemployment rate fell to 5.9%, while the rate for the 16 to 24 age group rose to an elevated 18.4%. It is becoming increasingly clear that the government's target real GDP growth rate of 5% or higher will not be met this year. And keep in mind that this target has been reduced in recent years as the decade's double-digit annual growth has faded. So, is this the end of the Chinese development model and the end of all this talk about moving towards socialism and so on? Many Western experts agree. In her quarterly report, Kathy Wood of ARK Invest raised the prospect of a U.S. recession and a significant slowdown in China. During the next 3 to 6 months, the market is likely to focus more on the risk of recession in the U.S., the serious slowdown in the Chinese and emerging market economies, and potentially a surprising drop in inflation, Wood wrote in her letter to investors. Real estate turmoil in China indicates a slowdown in the world's second-largest economy, and the flattening of the yield curve, or the difference between 10-year and 2-year U.S. Treasury notes, indicates an increased likelihood of a recession and lower inflation in the United States in the coming year. Others have also raised the prospect of a market downturn. Christina Hooper, Chief Global Market Strategist at Invesco, a firm with $1.5 trillion in assets under management, believes the odds are increasing because it has been so long since the last correction. And those odds have been heightened by the U.S. Federal Reserve's plans to reduce its balance sheet while raising interest rates. A recession, according to Wood, means that innovative tech stocks, such as those in which her firm has placed large bets, could fall into deep value territory over the next 5 years, a few she has previously expressed. Typically, during a slowdown, the adoption of new technologies accelerates as concerned businesses and consumers are more willing to change behavior patterns, she wrote, adding that the coronavirus crisis transformed the world significantly and permanently, suggesting that many innovation-driven stocks could be productive holdings during the next 5 to 10 years. Her remarks come as ARK Invest's flagship fund, The ARK Innovation ETF has already dropped about 20% this year. This comes on top of a 24% drop in 2021 following a star-studded 2020 when the fund increased by more than 150%. According to the website, the flagship fund's top holdings include EV maker Tesla, video communications platform Zoom, virtual healthcare company Teladoc, TV streamer Roku, and cryptocurrency exchange Coinbase. Despite steep declines in shares of high-growth companies such as Zoom and Teladoc over the last year, Wood previously stated that the stocks now represent a bargain as the companies improve their revenues and profitability. In fact, China requires more capitalism. The private sector must be expanded. But wait a minute, what are the root causes of the current real estate crisis and debt expansion? It can be blamed squarely on China's expanding private sector, which has been promoted by a sizable portion of the Chinese leadership, particularly in the finance and property sectors. China's investment expansion has increasingly been in unproductive sectors such as finance and real estate. Why, of all places, was home construction in China's burgeoning cities left to private capital developers offering mortgages to buy? Why were no homes built for rent by the state sector? As a result, the state is now dealing with a textbook case of a Western property market crash. This will have to be resolved by the state completing projects and restoring mortgagees' rights to their money. There will be no financial crash in China. This is because the government controls the financial levers of power. The central bank, the big four state-owned commercial banks, which are the world's largest banks, and the so-called bad banks, which absorb bad loans, big asset managers, and the majority of the largest companies. The government has the authority to order the big four banks to exchange defaulted loans for equity stakes and then forget about them. It has the authority to order the People's Bank of China to do whatever is necessary. It can direct state-owned asset managers and pension funds to purchase stocks and bonds in order to support prices and fund companies. It has the authority to direct state bad banks to purchase bad debt from commercial banks. It can persuade local governments to complete property projects. As a result, a financial crisis is ruled out because the government controls the banking system. The forecasts and hopes of Western experts that China is about to implode are clearly not shared by capitalist strategists in the United States and NATO. They do not anticipate internal disintegration and thus continue to try to strangle China's economy from the outside. And that's all for today's video. Thanks for watching. Do let us know your thoughts on this video in the comments below. Also, if you enjoyed this video, then like, share, and subscribe to our channel for more such exciting content. See you in the next one.